You know those kids that are extremely energetic, always jumping up and down, banging into furniture, breaking things, and parents are constantly trying to calm them down? And then suddenly the same kid becomes very quiet, doesn't get excited by anything, and now parents are worried for a different reason. Is my kid depressed? That's kind of the relationship between a central bank and inflation. You don't want the economy to overheat and inflation to surge so much that it can't be controlled. But then neither do you want inflation to turn into deflation, that is, prices keep going down as the economy stays depressed. At such times, like parents, central banks end up doing absurd, clownish, desperate things to cheer up the economy, which is what has been happening with Japan for the past 30 years. In a world battling with inflation, where central banks of US, EU, Canada, Australia are all hiking interest rates to levels not seen in the past decade, the Bank of Japan is still pumping money in the economy, trying to create inflation. Now, Lenin had once said that there are decades where nothing happens, and then there are weeks where decades happen. Last week, that is the week of 23rd July, was such a week for Japan, and its ripples were felt across the financial world. But to appreciate what happened and why it's such a big deal, let's start you off with a crash course. And by crash course, I mean a brutally crashed course. Like, this is the study material of a semester that I'm trying to condense in a few minutes, on why Japan has been in the midst of 3 decades of deflation. Now, in the 1980s and 90s, Japan was like today's China. Industrial powerhouse, cutting-edge technology, on the verge of challenging the US economy. In fact, if you're a 90s kid, you would remember how Sony Walkman, which for those of you who are younger, used to be these mobile audio cassette players, were the rage. Or, as a matter of fact, Nintendo's Game Boy, flying off shelves. Japan used to be the ultimate name in electronics, video games, cars, so much so that the US auto industry was threatened by being overrun by Japanese cars. Assisted by easy monetary policy, the economy picked up, stock markets were doing well, land prices shot up. Now, in the start of 1990s, the Bank of Japan, like any central bank, started to get worried that their economy is overheating. So, as economic textbooks would have told them, they started raising interest rates to control inflation. Little did they know that this routine course correction was going to change the course of Japan's history for the next 3 decades. Because guess what? Japan's economic bubble burst. The economy, share markets, real estate all started to fall. And when housing markets fall, be it anywhere in the world, it gets ugly. People that have bought houses at higher prices can no longer sell them. Now they are trapped by their mortgages, so they have to cut down on consumption. This in turn impacts companies. Meanwhile, banks and financial institutes start having to deal with loan defaults. In turn, they start to become unstable and start to default. And when your financial stability is at risk, then your whole economy is under massive risk. Which is why you often find that central banks and governments tend to be so keen in bailing financial institutions out. It's what is known as a balance sheet crisis for companies, households, banks, financial institutions. And all of this was rolling out in Japan. So now Bank of Japan goes, oops, I maybe shouldn't have increased interest rates so much, and started to aggressively cut interest rates down, taking it all the way to 0%. But it was too late. The economy was already in a tailspin. And the thing about deflation is that it's kind of self-fulfilling. So if you think that the price of something is going to fall next week, will you buy it today? No, you will save and wait. But then economic growth only happens when people consume. So if that's not happening, the economy will stagnate and the prices will actually fall, which in turn leads to the same cycle of expectations. Besides, Japan has an aging population, so more pensioners, less salaried workers, so more difficult for an economy to escape deflation. Also, Japanese labor markets have been very rigid. The focus has been on lower wages but stable employment. And there's been a culture of seniority, lower participation of women, so wage growth has also been pretty low in Japan. Again, this complicates the whole deflation issue. And look, it's not like the Bank of Japan didn't do or try out a lot of things to get this economy out of the rut. It started to do quantitative easing. Quantitative easing is what you as a central bank can do once you've already cut the policy interest rate to 0%. Then you start to also meddle with market rates. How do you do that? Well, you start to buy government bonds, you end up buying corporate bonds, and that causes their prices to go up. And when the price of a bond goes up, its yield goes down. I won't get into the maths of this. It's very simple. Have a quick Google if you like. So essentially, the central bank is flooding the economy with money because at the end of the day, it is buying all these bonds, buying money that it's generating. But even then, Japan remained in deflation. So then in 2016, the Bank of Japan set the policy interest rate from 0 to negative, which actually caused a lot of disruption. It's a bit like when the patient is not responding in one of those medical dramas like Grey's Anatomy, where they first inject stuff, then they apply those electrical shock pad things, and then they start to press the chest manually, and then some really hot doctor comes up and says, give me a scalpel, and the other hot doctor says, but it's hopeless, and then they cut something to revive the patient. So when a central bank decides to cut interest rates to negative territory, it is that stage. But despite doing this, the central bank just could not lift Japan out of deflation. Yes, there were brief episodes of growth, and then for some reason, be it domestic or international, the economy would again start to stagnate. Then the Bank of Japan started to do something known as yield curve control. What is yield curve control? Well, simply put, the central bank comes up and says, hey, I don't want my 10-year or 5-year interest rate to go up so much. So here's what I'm going to do. I will keep buying 10-year bonds from the market whenever their interest rates are going up. Why? Well, it raises the price of the bond and, as we mentioned earlier, brings down interest rates. In this way, the Bank of Japan had kept the 10-year interest rate in a tight range around 0%, basically saying that I won't allow even a little bit of rise in interest rates to disrupt growth. But now it seems that Japan is having its Kumbhakaran moment. So Kumbhakaran was the younger brother of Ravana in Ramayana, who would tend to sleep for ages before being awoken. And that seems to be happening with Japan. One thing that's gotten people really excited is the rising inflation. Japan's consumer inflation is currently up to over 3%, which has been above the Bank of Japan's 2% target for over a year now. In a post-pandemic, post-Russia-Ukraine world, turns out that even Japan isn't immune from inflation. This year, Japan's wage growth has been the highest in 30 years. The population being in decline, there's now competition from large firms of other Asian economies who are searching for that kind of labor, so the demand for labor is rising. And firms are starting to pass on these higher wage costs to consumers. So now people are wondering, hey, wait a minute, is Japan getting out of deflation? But if that happens, interest rates have to rise because higher inflation tends to lead to higher interest rates. But does that mean that the Bank of Japan will stop trying to control interest rates? The first major event actually happened in December last year. Remember, I had said earlier that they wouldn't allow 10-year yield on government bond to go beyond 0%? Well, in December, they announced that they will extend this to the range of minus 0.5 to plus 0.5%. Now, please understand how big a deal this is. This is not like a 0.5% increase in your home loan. This is an economy that for 30 years has been stagnating. Its central bank has not only kept short-term interest rates negative, which is the policy interest rate, but it has also been pumping money to ensure that long-term interest rates are close to 0%. It's like a North Korean version of interest rate control. And that country is now saying, you know what, I can allow my interest rates to go up for a bit now. And in the July meeting, they went ahead and said, look, we can now tolerate the yield to go up to 1%. And now everyone is on their toes. Is this happening? Is the Bank of Japan letting go of interest rates? And the Bank of Japan in turn is saying, not that fast. The last thing it wants to do is to say, yay, inflation is going up, let's raise policy rates. And then that hits growth, inflation again falls, and they're back to square one. So even its official inflation forecasts don't seem to suggest that the Bank of Japan is confident that inflation is going to be sustainably above its 2% target. But yet slowly and steadily, it is also giving itself the flexibility to react in case inflation does pick up. Because if it does, the Bank of Japan can let long-term interest rates go up to 1%. So the question that markets are asking now is, are we seeing the beginning of the end of ultra-loose monetary policy in Japan? Will the Bank of Japan abandon its policy of controlling interest rates to support the economy? And if so, when will that happen? For more such insights, like, share, and subscribe to The Bond Economist.